You can make $100,000 a year and still be broke. And the truth is, most people are. That's why today we're breaking down why money actually matters, not because of the things it buys, but because of the freedom it creates. If you're ready to finally break out of the paycheck to paycheck cycle and start building real wealth, hit like, subscribe to Gen W, and let's dive in. I'm Nick, and on this channel, we focus on making money work for you, not the other way around. So let's start with the big question: what is financial freedom? And more importantly, why does it matter? When I was younger, I thought the goal was simple: get promoted, make more money, climb the ladder, and repeat. But even as my income grew, something didn't change, feeling like I was making enough money. My stress did change though, and I realized that a bigger salary didn't automatically make my life easier. Financial freedom has nothing to do with how much you make. It has everything to do with how much control you have over your time, your choices, and your peace of mind. Income is temporary. Wealth is durable. Income pays today's bills. Wealth pays for the life you actually want. And here's the reality check. According to the Federal Reserve, only 46% of Americans have enough savings to cover just 3 months of expenses. That means almost half the country is one emergency away from panic mode. This is why money matters, not for status, for stability, not for flexing, for freedom. Now let's talk about something almost everyone has experienced: the paycheck to paycheck trap. You get paid on Friday, it feels great, but by Wednesday, the account is already shrinking or gone entirely for bills and necessities. And suddenly you're waiting for your next paycheck like oxygen. Panic, anxiety, and fear, these are all emotions I felt in that exact same routine. 61% of Americans live paycheck to paycheck. 45% of people earning over $100,000 a year still live paycheck to paycheck. So this isn't an income problem. This is a system problem. Ida Auken of the World Economic Forum has infamously been quoted saying, "You'll own nothing and you'll be happy. Buy now, pay later." The need for instant gratification and the dopamine hit that comes from spending money all play into why we have a real problem with money in society. For me, the light bulb moment was when I realized my lifestyle kept growing right alongside my income. Better job, better car, better phone, better trips, but no better savings. No investments, no real wealth. I can still remember my first big jump in salary and the feeling of expecting to feel rich, but after a couple of months of the higher pay, I was back in the same place financially. That difference in pay I was earning was going right out the door because my spending habits kept pace with my salary growth. I kept trying to figure out how I could earn more. I was beating myself and trapping myself in an endless loop. You have to actively want to change something. In this case, you have to actively pay yourself first by investing. More income without a plan for wealth just means more expensive habits. The paycheck to paycheck cycle destroys any chance of building something bigger. Because when every dollar is spoken for, you never get to put money into the things that grow. So let's break something down that most people misunderstand: the difference between saving and investing. Saving is your seatbelt. Investing is your engine. Saving keeps you safe in the short term and provides support against unforeseen risks. Investing builds your long-term future and provides the confidence that comes from generational style wealth. Savings belong in high-yield accounts, certificates of deposit, or emergency funds. Do not stuff money in your mattress, in a piggy bank, or even in your bank's standard savings account. These are all ways to lose value quickly. Savings accounts are your safety net. The recommendation for savings accounts is to have 3 to 6 months worth of expenses saved up and nothing more. Anything over that amount sitting in a basic savings is costing you money. But savings don't grow wealth, not anymore, because inflation eats your savings every single year. At an average inflation rate of around 3%, $1 today buys about 85 cents worth of goods in just a few years. Think about your bank's savings account. The national average interest rate is roughly 0.40%. So not only are you losing money parking it at your local bank, but your bank is loaning that money to others at 5 to 8% interest and giving you 0.4% in return. Sound broken? So if you're only saving, you're falling behind. The good news is it's never too late to start investing. Investing is where growth happens. Whether it's index funds, stocks, real estate, or your own business, investing multiplies your money through time and compounding. And zoom out and remember this stat. The average personal savings rate in the United States for money markets, high yield savings, etc. is only 4.4%, which means most people are saving too little to survive an emergency and nowhere near enough to retire comfortably. Saving protects you, investing frees you. Now let's talk passive income, because it's one of the most misunderstood concepts in finance. Passive income is not instant riches. It's not set it and forget it. It's money that continues to flow after the hard work has been done. Billionaire Warren Buffett famously said, "If you don't find a way to make money while you sleep, you will work until you die." Passive income can come from dividends, rental properties, REITs, online businesses, royalties, or simply owning stocks that grow over time. And here's a crazy stat. Only 12% of Americans earn any form of passive income, but 62% own stocks, which means the opportunity is there. It's just not being used correctly. Passive income is the key to financial freedom because it reduces your dependency on your job. It gives you breathing room. It gives you options. And it's how real generational wealth gets built. Here's the part that might hit hardest. Waiting is expensive. Let me show you how expensive. If you invest $200 a month at 8% return for 25 years, you end up with around $191,000. That is as simple as it sounds. Automate $200 a month into a long-term account and let it grow. But if you wait just 5 years before you start, that number drops to around $118,000. That's $83,000 lost just because you waited. Starting early beats starting perfectly every single time. And look, I was late to the game too. I thought I needed to make a certain amount first. I thought I'd start when things settled down, but things never settle down. Life doesn't slow down for your goals. So start now. Start small, start messy, but just start. $5 a day or $5 per week, take that and open a brokerage and set up auto investments. Start with investing in something like VOO, which represents the S&P 500. Let's clear up a few money myths that are holding people back. Myth number 1, high income equals wealth. Reality, net worth, not your paycheck, determines wealth. There are people making $80,000 a year with more wealth than people making $200,000 a year. It's not what's on your paycheck, it's what you do with your paycheck. Myth number 2, investing is risky. Reality, not investing is guaranteed loss. Inflation guarantees that. The stock market averages an 8% return over the last 30 years. It is one of the safest investment vehicles out there. Start simple, look at ETFs, don't rush into individual stocks, and you can see incredible returns on that alone. Myth number 3, I'll start later. Reality, later is the most expensive word in personal finance. If discipline is hard, automate it. Automation beats motivation every time. Look at the market this year. I know so many people who got nervous from the April tariff low points that they didn't want to invest. And then even when the market rallied, they then wanted to wait for the next big pullback. It never came, and now the market is up 43% from those April lows, meaning they missed all those gains. So here's your action plan to start building real wealth today. Step 1. Open a high-yield savings account and begin building your emergency fund. The average high-yield savings account is currently around 3.8%, which beats inflation and keeps money close in case of an emergency. Step 2. Automate $50 to $100 a month into an index fund, VOO, VTI, QQQ, IWM, whatever fits your long-term plan. Comment below if you'd like to hear my top long-term investment ETFs and why I chose them. Step 3, pick one passive income idea and research it this week. Just one. Build the habit before you build the empire. Dividends, real estate. Yes, you can invest without having to buy properties. Ask me how in the comments. Shares of companies. Pick one and do the research. Ask yourself if you can afford to wait any longer. Financial freedom isn't a dream, it's a direction, and every step you take now is a step your future self and your kids will thank you for. If this helped you, hit like, subscribe to Gen W, and drop a comment telling me your biggest money misconception. I answer every comment, and we're building this community together. Thanks for watching, and I'll see you in the next one.